All right, welcome to the deep dive. Today, we are digging into a really fascinating and maybe a little unsettling look at U.S. government bonds.
Yeah, in the national debt picture, and really the tight spot the Federal Reserve seems to be navigating right now.
We're focusing our lens today on one particular source. It's an article published just recently, May 31st, 2025. The title is Bond Yields Hit 5% as Fed Debt Denial Backfires. Pretty strong title.
It is. It's a dense read, lays out a pretty powerful case, and our goal here is really to unpack its core arguments for you.
Exactly. We want to cut through some of the complexity in this piece.
Call out the key insights it offers, about these rising bond yields, the sheer scale of U.S. debt, how global investors might be shifting.
And those challenges facing the Fed.
Right. And ultimately, to try to understand why this all matters, in your world.
And just a quick heads up, the article itself makes it clear, and we want to echo this, it's for informational purposes only.
Definitely not financial advice.
Right. Think of this deep dive as maybe your guide to understanding what the article is saying, not guidance for any investment decisions.
Okay.
So let's jump right in where the article starts. It looks at the official word from the Federal Reserve. What was the message from their May 2025 meeting, according to the source?
Well, the article reports the Fed held its main interest rate, the federal funds rate, steady,
Yeah.
kept it in that 4.25% to 4.50% range.
Okay.
And publicly, their reasoning sounded pretty optimistic, Solid economic pace, strong labor market,
Inflation coming down.
moderating. Yeah, though still above their target. That was the official line for holding steady.
Okay, so that's the public statement. But the article, it seems to suggest there was something else going on behind the scenes, in the minutes, maybe.
Yeah, that's where it gets interesting. The source highlights that beneath that official optimism, the internal meeting minutes apparently revealed growing concerns.
Ah, like what?
Worries about market volatility, liquidity stresses,
Yeah.
specifically in the Treasury markets, which is, pretty crucial.
All right, the market for the government's own debt. So the article highlights this disconnect.
Exactly. That's a key theme. This gap between the public message, fundamentals are sound, and this acknowledged internal unease.
And how does the source say this affects investors? Does it fuel skepticism?
Well, the article argues it does. It suggests this gap fuels investor skepticism. They see the data, the market moves we'll talk about, and maybe start thinking the Fed isn't fully acknowledging the risks.
Or can address them easily?
Right. And they start pricing those risks in.
The piece also mentions Fed Chair Powell's position in all this. Any political pressure mentioned?
It does note that Powell has reportedly been resisting political pressure. It specifically mentions calls from former President Trump to cut rates prematurely.
Mm-hmm.
And the article emphasizes that Powell's insistence on being data dependent is why rates have stayed relatively high despite those pressures.
So the tension here, as this article frames it, it's like the Fed is walking a tightrope,
Very much so.
trying to maintain credibility fighting inflation, which means keeping rates up, but also feeling pressure not to destabilize the government's enormous debt load. Higher rates make that debt much harder to manage.
Exactly. And the market signals, according to this analysis, seem to suggest that the debt problem, the sort of structural issue, is really starting to weigh heavily.
Okay, let's talk about those market signals then. The article describes a dramatic shift in the Treasury yield curve. What yields are we talking about?
Yeah, it highlights some pretty significant moves. The 10-year Treasury yield, a key benchmark, has been around 4.5%.
Okay.
But the 30-year bond yield actually touched and even briefly went above 5%.
5%, wow.
And the key point the source makes is that these are levels we just haven't seen in, well, over a decade.
And it says this points to a breakdown in how markets usually behave, like the safe haven idea.
Right. Traditionally, treasuries are the go-to safe asset. Stocks fall, money flows into bonds, prices go up, yields go down. But this article notes that recently we've seen treasuries falling in value at the same time as stocks, and even alongside the U.S. dollar. That's not typical.
And why is that specific behavior such a red flag, according to the source?
Because it signals a potential loss of confidence. A questioning of whether U.S. government debt really is that ultimate risk-free refuge anymore. Investors aren't automatically running towards it.
The article also mentions liquidity, that making things worse.
Yes, it points out that liquidity, how easily you can buy or sell large amounts without moving the price too much, has apparently deteriorated in the Treasury market, especially right after Fed announcements.
So less smooth trading.
Exactly. And the source argues this lack of smooth trading makes price swings worse, contributing to these sharp yield increases.
So putting it all together, the higher yields, the weird safe haven behavior, the liquidity issues, what's the article's conclusion here?
The article concludes that investors are basically reassessing the fundamental risk profile of U.S. debt. They're connecting the dots between these market signals and broader worries about, fiscal sustainability. Can the U.S. handle its debt and the limits on what the Fed can actually do about it?
Okay, let's talk about that debt. The article throws out a really an eye-watering number for the U.S. national debt.
It really does. The source notes it has now blown past $35.9 trillion.
Trillion.
Yeah. And maybe even more shocking is the rate of growth it highlights. Roughly $1 trillion added every 100 days.
Every 100 days. That's just hard to process.
It's an incredible pace.
And the article gives a breakdown of who holds all this debt.
It does. Based on the source, the Federal Reserve itself holds a big chunk, about $4.7 trillion.
Okay.
Foreign investors are also major players, holding around $8.7 trillion collectively.
Right.
But the largest share, according to the article, is held by domestic investors. That's things like pension funds, insurance companies, banks, even individuals. About $19.7 trillion.
And in that foreign holder category, the article singles out one country, Japan. Why does it call Japan a potential trigger point?
Okay. Japan is the single largest foreign holder of U.S. Treasuries, with about $1.13 trillion.
Okay.
The article warns that if Japan, for its own reasons, needed to start selling off a significant chunk of those treasuries, well, that could push U.S. yields much higher, potentially triggering a wider market reaction.
A sort of domino effect.
Potentially, yeah, making U.S. borrowing costs even more painful.
And this whole picture, the debt, the yield spikes, the changing risk view, the article says, this is changing how global investors think.
That's a key argument. It notes that big financial players like J.P. Morgan and Goldman Sachs are apparently reporting that their clients are actively reducing their exposure to U.S. dollar assets.
Pulling back from the dollar, where are they looking instead, does it say?
Yeah, the source mentions diversification to bonds from the Eurozone, Japan itself, and Australia.
And the reason given.
The article attributes it pretty directly to waning confidence in the dollar's stability.
Are there specific examples cited, like countries reducing holdings?
Yes, it points to China having cut its treasury holdings by around $200 billion since 2022.
Okay.
And it also mentions the BRICS nations, Brazil, Russia, India, China, South Africa, actively pushing for alternatives to using the dollar in global trade and reserves.
So the article's conclusion on this point is, this isn't just market noise.
No, it frames it as a potential structural realignment, a challenge to the dollar's long-standing dominance as the world's main reserve currency.
Which makes it harder for the U.S. Treasury to borrow money easily.
Exactly. Harder and more expensive to finance that huge debt.
Okay, let's loop back to Japan because the article connects them to this idea of potential market instability. It mentions some stress in Japan's own bond market.
Right. Things like failed government bond auctions there, rising yields within Japan.
And how does that connect to U.S. Treasuries? The article mentions the yen carry trade.
Yeah, it explains this historical trade. For years, Japanese interest rates were super low, so investors there could borrow yen very cheaply and then invest that money in higher-yielding assets overseas, like U.S. Treasuries, and profit from the difference in interest rates. The carry.
Makes sense, but now there's a warning about this trade unwinding.
Yes. The article cites a warning from J.P. Morgan suggesting that this unwinding process is maybe only halfway done.
Only halfway, meaning more selling could come.
That's the implication. It suggests Japanese investors might still need to sell a lot more of their foreign bonds, potentially up to 10% of their U.S. Treasury holdings, which is over $100 billion, to repay those old yen loans, especially if Japanese interest rates start to rise more significantly.
And the article draws a parallel between this potential large-scale selling and a past event, the taper tantrum from 2013.
Exactly. That's the historical echo it raises. Back in 2013, just the hint from the Fed that they might slow down their bond buying caused a massive spike in Treasury yields and mortgage rates. Chaos.
Right, I remember that.
So the article suggests a similar kind of yield surge now, maybe triggered by Japanese selling or just broader loss of confidence, would hit the Fed much harder this time.
Because their position is already more precarious.
Right, and it would directly jack up borrowing costs across the whole U.S. economy, government, mortgages, companies, everything.
And the article says these warning signs aren't just in government bonds, they're showing up in corporate credit markets, too.
Yeah, it shifts focus there as well. It highlights a surge in the cost of something called credit default swaps, CDS, specifically on U.S. government debt.
Okay, CDS. Remind us what that is again in this context.
Think of it like buying insurance. In this case, insurance against the U.S. government actually defaulting on its debt.
Okay. And the article reports a big jump in the cost of that insurance.
A dramatic jump. It gives numbers. The annual cost to insure $10 million of U.S. Treasuries reportedly rose from around $29,000 to over $51,000.
Over $50,000 to insure supposedly risk-free debt. What does the article say that signifies?
The source is pretty direct. It says this spike reflects growing market concern about the possibility, however remote it might seem, of a U.S. sovereign default.
Something once considered unthinkable.
Exactly. It shows sophisticated investors are actively hedging against this risk, which fundamentally challenges that bedrock idea of U.S. debt being risk-free.
And this nervousness spills over into the corporate world.
The article describes a spillover effect, yes.
How does that look?
It points to junk bond spreads widening significantly. That's the extra yield investors demand to hold riskier corporate bonds compared to safer treasuries.
Okay. How wide have they gotten?
The source says they're now over 600 basis points above treasuries.
600. So 6 percentage points higher yield.
Exactly. 6% more yield demanded for risky corporate debt. The article interprets this as a sign of much higher perceived default risk for companies with lower credit ratings.
Worries about the economy, maybe. Company health.
That's usually what it signals, yeah. And the source adds a point about the Fed.
That their ability to act as a backstop is limited.
Right, because the Fed's own balance sheet is constrained after all the previous interventions, the article suggests it might have less firepower to step in if things really get rocky in the corporate debt market, leaving it more vulnerable.
Okay, so this really paints a picture of the Fed being in an incredibly difficult position. The article calls it a no-win calculus or a policy trap.
Yeah, that phrasing really captures the dilemma it describes.
Lay out that trap for us. What happens if they raise rates?
Well, the article argues that if the Fed raises rates more aggressively, say, to really stamp out any remaining inflation,
Right.
it massively increases the government's interest payments on that $36 trillion debt. As an example, just a 1% rate hike could add over $350 billion a year to the interest bill.
Wow. Just for interest.
Just interest. And the source warns this risks causing a fiscal crisis, not to mention huge political blowback.
Okay, so that's one side of the trap. Raise rates, risk a debt crisis. What's the other side? What if they cut rates?
Cutting rates might normally stimulate growth, but the article argues doing that now could be risky too.
How so?
It could reignite inflation, which, as we said, isn't fully back in the bottle yet, and it could weaken the dollar further internationally, potentially speeding up those global investor shifts away from U.S. assets.
Making the funding problem worse.
Exactly. So, damned if you do, damned if you don't, essentially.
And the article's conclusion on this point, the Fed is stuck.
It basically says the Fed is effectively paralyzed. That's the phrase used, suggesting they can't really make a significant move in either direction without risking some pretty severe consequences based on all these pressures.
The article also dives into inflation itself, mentioning this kind of tug of war.
Yeah, it talks about inflation being stubbornly sticky, still hanging around.
And it blames things like tariffs, supply chain issues.
Partly, yeah. Factors that are kind of outside the Fed's direct control via interest rates.
But then there's a counterpressure, something pulling the other way, deflation risk.
Right. It introduces this idea that a potential Treasury market meltdown, like if Japan sells big, or just a general crisis of confidence leads to bond prices crashing, could actually create powerful deflationary forces.
How would that work? Falling bond prices causing deflation.
The source explains it could happen if collapsing bond values wipe out wealth, and if credit conditions tighten dramatically, making it super hard for businesses and people to borrow and spend. That could slow the economy drastically, potentially leading to falling prices overall. Deflation.
So this inflation-deflation tug of war described in the article, being pulled in both directions at once. What does that mean for the Fed's job?
The source argues it makes their job incredibly difficult, maybe almost impossible. It severely limits their policy options.
Yeah, because they usually want to fight one or the other.
Exactly. Being caught in the middle like this, with these big structural forces pulling both ways, it significantly raises the risk of, well, bad outcomes, like stagflation, inflation plus stagnant growth.
The worst of both worlds.
Right. Or even a full-blown debt-driven market crisis. It just makes the Fed's position incredibly precarious, according to this analysis.
Which brings us to the article's main conclusion, its central argument.
Yeah, it all ties together here. The core argument is that the Federal Reserve's relatively positive official story about the economy.
The soft landing narrative, maybe?
Right.
Yeah.
That narrative is increasingly out of sync, maybe even clashing with the realities that the market seems to be signaling very loudly.
And the article finishes by listing the specific signs it sees as evidence of this disconnect, this potential crisis.
It does. The conclusion recaps those points.
Yeah.
Bond yields hitting that 5% mark, the cost of insuring U.S. debt surging, the rally we've seen in gold.
See, as another safe haven, maybe.
Often, yeah. And that trend of global investors diversifying away from the U.S. dollar. The article puts all these together and says they point to a growing crisis of confidence in U.S. fiscal management.
It also makes a pretty stark claim about investors already positioning for trouble.
Yes. It observes that, quote, mounting evidence suggests sophisticated investors are already positioning for potential monetary system instability, essentially regardless of what the Fed is saying publicly.
Betting against the official narrative.
In a way, yes, or at least hedging against the risks the article highlights.
And it draws a historical parallel to drive the point home.
It does. It reminds readers that history shows losing monetary policy credibility, especially when combined with big fiscal problems, can lead to severe economic pain. It specifically cites the 1970s stagflation era as a cautionary tale.
Not a period anyone wants to repeat.
Definitely not.
So the article's final warning is, what? Without action?
The final warning is pretty stark. Without decisive action on these deep-seated structural debt and monetary challenges, the U.S. risks entering a protracted period of financial instability.
And it leaves us with this thought about the Fed's denial.
Yeah, it suggests that as markets keep pricing in these risks, higher yields, higher insurance costs, the Fed's narrative, which the article calls denial, might soon hit its limit, its expiration date, as they put it.
Forcing some kind of reckoning.
Forcing a reckoning with what the article sees as an unsustainable path.
Phew. Okay. That was quite a deep dive into, a pretty powerful and frankly, a bit of an unsettling analysis from this article.
Yeah.
It really lays bare the complex pressures on the bond market, the sheer scale of the U.S. debt challenge, and this really difficult spot the Fed finds itself in.
It certainly gives you a lot to chew on, doesn't it? I mean, this piece paints a picture where the market signals seem to be getting louder, maybe louder than the official statements. So thinking about all these pressures on the Fed, the global shifts away from the dollar that the article describes, what might be the potential ripple effects, for everyday borrowing costs, for economic stability down the line? What part of this picture really stands out to you as something critical to watch?
That is definitely the question to ponder, isn't it? Thanks for joining us for this deep dive.